Hi class, this video is going to focus on exercise 8.1, which is all about preparing an income statement. So it's the first textbook question of chapter 8, and you'll find that in your textbook on page 125. And if you're doing it along with me, you'll open your workbook up to page 85, and that's a really good way to work through the exercise together. So as I just mentioned, this is a question asking you to make an income statement, probably the first one you've ever been asked to make in accounting. So we're going to go through nice and slow and try and work out which of this information is revenue and expenses, because you remember that this is what we record in an income statement, and ultimately we're trying to work out the profit. Let's have a look at the question before we jump into what we need to do. So who are we in this question? We are a business owned by Christian Malavindi, who makes guitars. So we have been provided a statement of receipts and payments for 1 month ending 31st of January 2023. Remembering, we don't really care about the year in this case, it's just from the textbook. So we've been asked to do something in this question. Question A asks us to prepare an income statement for the month of January. So we're going to look at this statement of receipts and payments, which, remembering, is telling us all the cash receipts, so cash that has come into our business, and all our cash payments. And we're going to use this information to try and make an income statement. Now, if we look at this, did we make cash in this month? We did. We made $5,365 of cash because we made $10,990 of total receipts, and we paid $5,665. So we made more cash than we paid. But we now know there is a big difference between cash and profit. There is a big difference between cash receipts and revenue, and cash payments and expenses. We know that there are, for the cash receipts, not all of them are going to be revenue, because there are 3 things that need to be ticked off before we can say these receipts are revenue. And there will be, in fact, some revenues that aren't cash, but we're lucky in this question that there is none. So what are the 3 things that need to be ticked off for working out if it is revenue? And remembering, we need to tick all 3 of these boxes for it to be considered revenue. So we're going to go through the process of looking at these 4, or in fact 5 cash receipts, and I'll number them so it's really clear. 1, 2, 3, 4, and 5. We're going to go through and see, do they meet the 3 requirements? What are the 3 requirements for revenue? It needs to be an inflow of benefit. And if you're asked a question, why is this revenue, you're going to use this terminology. This inflow of benefit has to result in an increase in assets. And very, very occasionally, it could be because it results in a decrease in liabilities, but ultimately 99.9% of the time, we're going to think, has this receipt increased our assets and also increased our owner's equity, or the amount our business is worth? So let's go through the 5 and think, are they revenue? The fees of individual customers and studio customers are both revenue. They have, if we tick the box, we can tick the box that there is an inflow. There has been fees or cash coming into our business. There has been an increase in an asset because our cash has gone up, and cash is an asset. And importantly, there has been no change to any other asset, no change to a liability. So for our accounting equation to balance, this cash that's come into our business is going to increase how much our business is worth. So it's an increase in owner's equity. So we can put both of these two into our income statement really confidently as revenue. So let's do that. And we're going to do a bit of shorthand just so it's a quicker video. We have guitar fees to individuals and guitar fees for studios customers. Now, if you have enough room, you'd write all of it, but that's okay. And then we've got two columns here, and it's the same concept of all our reports. If we have more than one thing to write down, we're going to put it in the left column, and then we're only going to put the total on the right. So because we know we're going to have more than one revenue, we're going to put them down in our left-hand column. Then we've got interest from the bank. So let's think about that one in terms of our three tests. That means we have earned cash from our investments in the bank. Do we have an inflow of benefit? Absolutely, because we have inflow of cash. That is a benefit to our business. Our assets have gone up because we've got more cash, so you can start to see a pattern. The big test is, has this impacted another asset or liabilities? And in this case, no, we don't need to pay this interest back. It hasn't been used to purchase another asset, so our business is worth more money. Think about it. Interest has come into our business. We've earned $220. That makes our business worth $220 more. So we can say that that one is also revenue. However, the next two, and I'm going to put a big cross next to them, the next two are not revenue. Why not? If we think about this loan that we've taken from NAB, there has been, we could argue, an inflow of benefit because we've got $4,500 of cash coming in. It has definitely created an increase in an asset because our cash has gone up. However, there has been no increase to our owner's equity. Why? Because to balance our accounting equation, our owner's equity doesn't go up, but our liabilities go up. So our balance accounting equation of assets equals liabilities plus owner's equity still balances because these two have been impacted. No change to owner's equity, so no revenue. GST collected is also never revenue or an expense if it's GST paid, because we don't consider this part of profit, because we are just a tax collector collecting and receiving GST to give to the government. So there are only 3 revenues from the 5 cash receipts. If we add these up, and we will do this, it will equal $5,920. So we have $5,920 of revenue, which is much less than our cash receipts. So we have ticked off the 5, and now we have in our cash payments 1, 2, 3, 4, 5, 6, 7 cash payments. And our question is, how many of them are going to be expenses? You might remember there is 3 things that need to be ticked off for us to consider a payment or anything to be an expense. It makes sense when we start to think about it that these would be the opposite of the tests of revenue. So instead of it being an inflow, we're going to need it to be an outflow of benefit. Instead of an increase in an asset, these payments are going to equal a decrease in assets, or very, very rarely an increase in liabilities. And it's going to need to result in a decrease in owner's equity or a reduction in how much our business is worth. If we go through this, there are just 4 of the 7 that count as expenses. And these ones are timber, wages, advertising, and office expenses. So our drawings, purchase of tools, and GST paid have nothing to do with expenses, even though they are paying of cash. Let's run through the logic, the test that you're going to do in your mind so we really understand it. In this case, we have paid for timber. If we think of timber in a guitar maker, it is almost certainly inventory. There is an outflow of benefit because we've paid cash, and our assets have gone down because of cash. Now, if we think about it, this paying of cash, this outflow of benefit, has not impacted any other assets. No other assets are impacted. And we have an outflow of owner's equity. So we can say that our timber is an expense. We can also say our wages are an expense because in this same quotient, there has been an outflow of benefit. We have paid cash, and this is an expense because there is no change to our liabilities or any other assets. So let's chuck these two in. $980, $1,600. Office expenses is the same because there has been no change into other assets other than the reduction in cash. It is just expenses. There is a Q there. It says expenses in it. And we might think of these as photocopying and all that sort of stuff. And also if we pay for advertising, this is also an expense. It meets the 3 other requirements. An outflow and benefit, cash leaving the business, so a decrease in an asset, and no other impact to our accounting equation other than our owner's equity going down. Why are the other 3 not expenses? There is a specific rule that says drawings is not an expense because we want to kind of keep separate our profit figure and money leaving our business for personal use. There is characteristics and assumptions about that. Our purchase of tools means that our asset of cash goes down, but our asset of tools goes up. So there has been no change in our assets. So we can't tick off the second one that says there must be a decrease in assets. And then we know that GST never has anything to do with revenue or expenses because we're just the tax collector. So if we add all these up, just like we did the expenses, we would get $3,170. And then we can work out profit. 5,920. I'll write it up here just so it's clear. 5,920 minus 3,170 means we have made $2,750 worth of profit. We have now done your very first income statement. Well done. Hopefully that made sense, remembering there is anytime you are saying there is revenue or expense, you need to tick off those 3 rules. And after a while, you'll just get really used to knowing that these things are revenue and expenses, and you might not have to do it. You'll get really comfortable at understanding, for example, advertising, expense, wages, expense, fees, revenue, etc. But as we're getting new to it, I want you to slowly go through that. Part B in this question, and this is really the only other one that we're going to do in this question, asks us to prepare the owner's equity section of the balance sheet. So if you remember the balance sheet, it'll look something like that. All your assets listed on the left, your liabilities listed on your right, and to balance it, we write how much our business is worth. we have enough information to put all the information to balance the balance sheet and ultimately say how much our business is worth. We originally started with a starting capital of $25,000. So our owner's equity is going to start looking like this. Capital, $25,000. Now, something has happened in the month of January that has made our business worth more. Can you think what that is? It is our profit figure here. Our business is worth $2,750 more than the start of the month. So we're going to add net profit of $2,750. And in your balance sheet, there was always 2 columns, and it makes sense to now total this. It is going to be $2,750. We're then going to add less drawings, because you might remember we've excluded that from our expenses, but it is still money leaving our business that's important. And how much was our drawings? $930, and I've made a little mistake. We put it here, and we put it in a bracket because brackets are important to say how much, to say it's a negative. And then we would do this minus this, which off the top of my head is roughly $2,600 and $880. And I might have got that slightly wrong because I'm doing that off the top of my head. Now guys, that is how, and look at the solutions because it's ended up being a bit messy here, how we importantly do your very first income statement, doing the 3 tests to see if it's revenue or expenses, and then we have prepared an owner's equity section. Part C is one that we're not going to do, and it states, and you need to find 4 items that appear in the statement of receipts and payments that aren't in your income statement. And we've gone through them quickly to say which ones aren't, and you're asked to say why. You would talk about the loan, the GST collected, the drawings, purchase of tools, and the one that I scribbled out, GST paid, and say why they're not revenue expenses, talking about the 3 things that need to be ticked off, and you'd say which one has not been met. In terms of the GST, we can make a calculation to say that we have collected $570, so part D, we've collected $570, we have paid $285. If we've collected more than we've paid, we owe something to the government, and that would be the difference. And off the top of my head, that is $285 that we owe to the government. And guys, that would be how you do quite a complicated first exercise of chapter 8.1, and you have now made your very first income statement. So well done. As always, after you make a report, have a look at it. Would you be happy with that as a business? What would be your recommendation? But more importantly at the moment, keep practicing income statements, keep practicing identifying what is revenue and expenses, and you'll quickly become that expert accountant. The income statement is one of the most important reports that we make, and we are going to become experts at making them and analyzing them. Well done.